New listings across the GTA just fell almost 18%, and the market is still in buyer's territory. That combination shouldn't happen, and what it tells us is more interesting than any headline you'll read today. New listings across the GTA fell 17.8% in July, and that's a big number. Sellers pulled back hard. Now, here's the part that matters. Normally, when supply drops that sharply, the market tightens and you'd expect prices to firm. That didn't happen. The average price still fell 4.5% year over year, and by TREB's own sales to new listing measure, the GTA is still sitting in buyer's market territory. So we've got a market where supply contracted significantly and it barely moved the needle. So that tells us something real about where demand is. And it sets up two very different possible outcomes for the rest of this year. I'm Anthony Malfara, Toronto real estate broker. No spin, no cheerleading, just what the July numbers actually say. Let's go through it, starting with the hard counts, the numbers that aren't modeled or adjusted, just counted. So just under 6,000 homes changed hands across the GTA in July. That's down almost 1% from July last year. So essentially flat. There is no demand surge in this data. New listings down 17.8% year over year, just under 15,000. And that is a standout figure of the month by a wide margin. Sellers really stepped back. Active listings just over 26,000, down 12.1%. So total available inventory shrank also, though less than new listings did, which tells you some of what came to market in previous months is still sitting there. Now, the ratio that classifies the market, sales to new listings, TREB's trend measure is 37.1. Below 40% is a buyer's market, between 40 and 60 is balanced, above 60 favors sellers. At 37.1, the GTA is in a buyer's market still. That hasn't changed. Now, worth being precise here, if you take July on its own, sales divided by new listings is about 41%, so just barely into balanced. The trend figure smooths several months and sits lower. So the direction is improving slightly, but the level is still soft. Both things are true. Months of inventory, 4.6. Historically, when that number drops below about 4, prices tend to firm. We're above that. So prices, average price came in at just over $1 million, down 4.5% from July 2025, barely above the $1 million line. The MLS Home Price Index benchmark, which is the kind of the like-for-like measure that strips out which types of homes happen to sell that month, is 934,600, down 4.63% year over year. So both measures agree prices are down mid-single digits from a year ago. So I'm going to note one thing here, and then I'll move on because I don't want to overweight it. The HPI on a seasonally adjusted month-to-month basis ticked up slightly in July, as it did in June. That's a model number. The moves are small and it gets revised. It's worth watching. It's not evidence that prices are rising year over year. They're clearly down, obviously. Average days on market, that's list date to sale date, is 32. But average property days on market, which tracks how long a property has been trying to sell across relistings, is 45. That's a 13-day gap, which means homes are being taken off market and put back on. That's a sign of sellers who couldn't get their number the first time round. Sales to new list ratio, 98%. On average, sellers accepted 2% below asking price. Now, let's look at the property types, like by property types. And the pattern here is important because it's uniform. Detached homes in the GTA, 2,789 sales, up 0.6% year over year. The only segment with a volume increase. Average price was down just below 1.3 at 1,291, down 5.1%. Semi-detached homes, there was 557 sales in the GTA, down 5.9%. Average price just under 965,000, which was down 7.4%. The sharpest price decline of any segment this month. Townhouses, there was 567 sales, down 2.7%. Average price just under $904,000, down 3.9%. Condo apartments, 1,564 sales, down 0.1%, so pretty much flat. Average price of $636,000, down 2.3%. You can see the condo market is it's it's kind of stable. So here's a takeaway. Every single property type is down on price year over year. This isn't one weak segment dragging down like an average around. It's broad based. Interestingly, condos held up best on price this month at just under 2.3% decline, and semis did the worst at 7.4%, which is the reverse of the pattern we saw through much of 2025. I mean, I wouldn't build a thesis on 1 month of that, but it's worth noting that the condos are the problem narrative doesn't fit July's data, at least. Inside the city of Toronto, there were 2,242 sales, new listings at 4,980, active listings at 9,310. Average price just over $1 million at $1,010,000. The city is holding just above $1 million on average, though like the broader GTA, that's a lower number than a year ago. Now, the sales to new listings trend for the city is 38.1, marginally above the GTA's 37.1. So the city is a touch tighter than the region, but still in buyer's market territory. Months of inventory at 4.6, same as the GTA, and the sales to new list ratio is 97%. So city sellers are accepting 3% below asking on average, slightly worse than the GTA's 98%. Average days on market is 32. Now, one local exception worth flagging: Toronto's East End sales to list ratio is at 101, meaning homes there are transacting slightly above asking on average, which means they're either getting in multiple offers or getting slightly above ask. If you're a buyer who has been looking east because you assumed it was, better value, understand that, competition there is real right now. So let's talk about what this data actually implies. And I want to give you, both directions, honestly, because the data supports both. Let's start with the macro picture. And I'm pulling this from Bank of Canada and Stats Canada, not from the real estate board. So the Bank of Canada overnight rate is 2.3%, which held flat. Prime is 4.5%. Mortgage rates as reported, 1 year fixed around 5.49, 3 years around 6.05, 5 year fixed around 6.09. Now, these are the postal rates. You can obviously get better rates at the bank. Notice something there. The overnight rate is 2.3, but the 5 year fixed mortgages are above 6%. So fixed mortgage rates aren't set by the Bank of Canada. We've talked about this before. They're driven by bond yields. So if you're waiting for the bank to cut and assuming your mortgage gets cheaper, that link is weaker than most people think. Watch the 5-year Government of Canada bond yield if you want to anticipate fixed rates. Now, Toronto's unemployment came down to 7.2 in June from 7.6, and employment grew 0.9%. That's improvement, and it's real, but 7.2 is still an elevated unemployment rate by historical standards. Improving from weak is not the same as something being strong. GDP in the first quarter of 2026 was just negative 0.1%, still slightly contracting. Inflation in June, 2.8%, down from 3.2, below 3%, but still above the bank's 2% target. So, an economy healing from a soft patch, not a booming one. Now, the two scenarios. The case that prices firm from here. So, supply has genuinely contracted, inventory is falling, employment is improving, and inflation is easing, which supports household confidence. Sales and listings are leading indicators. They move before prices do, typically by 3 to 6 months. So if demand picks up even modestly against this reduced supply, the math pushes prices up. What would confirm it? The sales to new listings trend moving above 40% and staying there, longer than a month. Days on market shortening and the sale to list ratio moving back towards 100%. That would kind of firm things up from a forward trend. The case that prices stay flat or drift lower, that 17.8% drop in new listings may not be a supply shortage. It may be discouraged sellers. People who tried to sell didn't get their price and withdrew. That's latent supply. It comes straight back the moment prices show any firmness, which could mean a recovery. And here's the telling part. Despite listings falling almost 18%, The market is still in buyer's territory at 37.1%. If demand were solid, a supply cut that large should have pushed us comfortably into balanced or better. It didn't. The gap between how much supply left and how little the market tightened is a demand signal, and it's not a strong one. The 13-day spread between list date and property date days on market points the same way. What would confirm this scenario, if new listings, rebounding sharply in September and October, active inventory climbing again, sale to list ratios staying below 97%. Guess what? I don't know which one happens. Anyone who tells you they do is selling something. Chubb, for its part, projects a stronger second half. That's their published forecast. And it's worth knowing that that's their view. But July's data doesn't obviously confirm it yet. What I'd watch over the next 60 days, the September new listings number, and whether the sales to new listings trend crosses 40%. Those two together will tell you which scenario is playing out well before prices do. And guess what? I'll be sharing that with you in the next few months anyway, so you don't need to go searching for it. So for buyers, you're in a buyer's market by the standard measure, 37.1 sales to new listings, 4.6 months of inventory, sellers accepting 2 to 3% below asking on average, and prices down mid-single digits from a year ago. That is real negotiating leverage, and you should use it. Where it's tightening, inventory is falling, and in Midtown, it's tighter than the city at 3.9 months. So the supply of options is narrowing, even though your pricing leverage is still there. So from a practicality standpoint, if you find the right property, the data supports negotiating firmly on price and on conditions. The relisting activity in the numbers tells you a meaningful share of sellers on market have already failed to sell once. That's useful information at the negotiating table. On timing, I'll be straight with you rather than kind of pushing urgency. If the firming scenario plays out, waiting costs you. If the latent supply scenario plays out, waiting is fine and possibly better. No one can really tell you which one it'll be. What I'd say is buy when you find something that works for your life and your finances, and negotiate hard when you do, because right now the numbers are letting you do that. On financing, don't assume Bank of Canada cuts translate into cheaper fixed mortgages. Get a rate hold, and if you're comparing fixed and variable, have that conversation with a broker specifically about where bond yields are heading. That's what you want to watch for. If you're a seller, I'm going to give you the real version. Prices are down between 4 and 5% year over year, depending on the measure, and every property type is down. If you're benchmarking your expectations against what your neighbor got in 2025, you should adjust. That's the starting point for an honest conversation. Here's what's genuinely in your favor. New listings fell 17.8%. Your competition on market is materially thinner than it was a year ago. In Midtown, inventory is at 3.9 months versus 4.6 citywide. If your property is well prepared and correctly priced, you are competing against fewer alternatives than at almost any point in the last 2 years. So your competition is less. Here's what's working against you. Buyers have leverage and they know it. Sale to new lists, 98% across GTA, 97 in the city, 95 in Midtown. You can expect to negotiate. Days on market are 32 to 36, depending on where you are. And the gap between list date and property date days on market tells you a lot of sellers are relisting because they priced wrong the first time. Overpricing in this market doesn't cost you a few weeks. It costs you the momentum of a fresh listing, and you get a worse outcome second time around. That's what we've normally seen. So the strategy is pretty straightforward. Price it to the current market, not to last year's, and not to what you hope. Presentation matters more when buyers have options. Get the pricing right on day one. On timing, if you need to sell, the thinner competition is a genuine advantage right now, and I wouldn't wait for a better market that may not come. If you don't need to sell and you're not in a hurry, holding is a defensible choice. But understand you'd be betting on the firming scenario that I talked about, and The data doesn't guarantee that, obviously. That's a decision about your own circumstances, not a market call. And I'm happy to walk you through it with you specifically. So that's July. Prices down 4.5% year over year. Sales flat and a big drop in new listings that hasn't yet moved the market out of a buyer's territory. Soft with one development worth watching closely. The two numbers I'll be checking first when the August and September data lands, new listings, and whether sales to new listings crosses 40%. I'll walk through them here when they do. If you want a straight read on your own situation, buying or selling rather than a market average, reach out. Link in the description. DMs are open. Remember, the averages, the GTA, those are averages. If you need to know your specific market, your micro market, those are very different. So if you want information about that and an analysis on that, reach out. I'd be happy to do that for you.